Hi guys. As you can see, we haven't done one of these in a little while, but we're back in the cave. And markets overall have been kind of flat. They go up a percent, they go down a percent, but by and large, they're, other than the big dump that they had back a week or so ago, which is really kind of nothing more than a correction. It was probably on the books anyway. We don't see too much going on other than for the year. In general, investments are flat. So that if you're a person with a 401k, and this actually the president was talking about this the other day, that if you have a 401k, it may have gone up or down in value depending on the market. And why is that? That's because the only place you can put your money for most of us folks on Main Street is in the market through ETFs or maybe your 401k. In most of the cases, I think we tend to have investments of some sort. Sometimes they're based on company things. Sometimes they're investments you might deal with in other ways. So that the 401 tends to be the place where we put money for our retirement. And in general, these are usually based upon the market, indexed to the S&P or Dow or something. Mostly the S&P. S&P is probably the one that gets indexed the most often. Anyway, so for the year, the S&P is basically flat. It's gone up and down. It's had some big downs and little ups. But by and large, the beginning and the end of the year, if you measure across it, is essentially flat. So your 401k may not have performed very well in the past year. Corporations and the market in general, we still see a big, really, everybody for the past, more than actually for a few years in some respects for some folks, that there's been a flight from what you would call growth stocks into value stocks. Growth stocks usually means that you're buying into a stock because you believe it will rise in value. And value stocks are stocks that you buy because they're big, solid companies that give you good dividends, and their stock price may not change a great deal, but in fact, the dividend is what you're looking for. So I own Ford just for that exact reason. Ford's dividend is actually quite good. So by and large, it's one of the few places I can put any kind of money and end up with 4, 5, 6% a year, somewhere in that range. Actually, it's more like 4 when you break it all down one way or another. So the market in general is a flight away from stocks. We're starting to see people, we know that the gold prices have been steadily rising since, a few months ago, where all of a sudden everybody started trying to figure out, where can I put my money? So this is where we tend to have people who have lots of money kind of go, well, let's see where I can put it to make it safe. So you're going to buy maybe gold futures, real gold, whatever, some kind of gold, because gold is basically a stable currency that even in the middle of a big crisis, gold doesn't essentially lose its value. It's, in fact, if you're a gold person, we have a friend who is a gold person, and he actually keeps real gold. I mean, whether it's in Kruger runs or little bars or whatever it is that he has. And that's because these people are afraid that at some point when this all goes to hell in a handbasket, and of course anything can happen, that might be true, the press tickles that edge of the craziness quite often. So it's a good chance that we could very well be in a deep recession in the next year or two. The markets have pointed to that. We've talked about inverted values and so on and so forth. And that's really where I was going to say, I wanted to get to that point, because the point is what the hell is all this about inverted, treasuries? Well, the federal government sells its debt. We've talked about this before. The Federal Reserve is actually the buyer of all the debt. So if Congress spends a whole bunch of money, the federal has to buy it by selling shares in the federal government to other people. Japan owns a huge amount. China owns a huge amount. Europeans a little bit less. So there's lots of people who buy our debt. And in order for us to spend as much money as we're spending, and actually we have now reached the point of where we are at $22.5 trillion that we have to sell to somebody. That's our debt for the moment. And it's getting more difficult because the European markets are down. Their central banks do not have, they're at zero interest rates and maybe negative interest rates. So nobody's going to invest in this. So because our bonds are at least at 1 point something, maybe a little more, maybe a little less, that there are people buying U.S. federal bonds much more often. But when they talk about this, we have different bonds that are sold by the government. I think it's every quarter, maybe every month. I have to go back and look at that. So we sell, we sell very short ones, which might be 30 days or so. But the big ones are 2-year, 5-year, 10-year, 30-year. So when they talk about the inverted yield curve, usually what they're doing is they're comparing 10-year notes versus 2-year notes. So if the 10-year notes are up, that means that people have faith in the fact that 10 years from now, the U.S. government is going to be able to pay whatever the percentage rate is. I think at the moment it has been around 2.5 or something in that range, maybe 2.1. And so they will buy the 10-year. Now, when you start seeing the inverted curve, meaning that people have gone away from the 10-year and they're buying 2 years more commonly than they buy 10 years. And so what happens is that the 2-year rate is like at 2.1 today, let's say, that if they buy a lot of those, they drive that price up to maybe 2.8 or 2.9 or something like that. And at some point, they could even rise above the 10-year. That's when we talk about an inverted curve. Now, why would people do that? Why would you take a lesser interest rate for a shorter period of time as compared to taking a much better rate for a longer period of time? And the reason is that they don't have any faith in the future, that they have no faith that what we're doing is going to actually pan out. And if a recession is going to come, they want to be in short money, meaning that we want to be able to take our interest a lot quicker than waiting out 10 years or so. That's why people end up buying lots and lots of 2 years, and the 2 years have been selling very well. And why for a moment, and usually it's not something that goes on for a long period of time. Usually it's a fairly brief period. If you look at over the years, inverted yield curves have happened, 5 or 6 times through a lot of different presidents. And the inverted yield curve basically says that for the moment, people are not trusting what's going to happen in the future. That we're going to buy short, and we're not going to invest in these long-term investments. So that's really what happened over the past month or so. And actually it's stabilized a bit. The 2-year is down, the 10-year is up. Okay, so we've kind of gone there. But what it's telling us is that we look statistically against these numbers, we start seeing that that's one of the flags that says, well, maybe we're heading towards a downturn. And actually, when you start looking at some of these things, you start realizing that, yeah, maybe we really are, because that we start seeing more layoffs at factories. We see corporations trimming back on spending money on new products and new lines and so on and so forth. CapEx is what it's called. There's been a lowering of CapEx. The other one is odd because it actually is the opposite way, that home buying tends to go up. Now, home buying is tied to an old rule about where can I hide my money. Well, in general, there's been a kind of a garden rule that says you want to put money someplace, put it into real estate. Real estate never goes down, so we're going to buy real estate. So go out and buy houses. Now, and it's a good deal right today because the interest rates on mortgages is damn near zero. I mean, so they're down into the 2 and 3% range for mortgage rates. So why not buy another house? Oops, wait a minute. Let's go back and take a look at 2009, 10, 11, things like that. What gave us the crunch last time? Overbuying of housing, people basically investing more than they could afford to invest into something, and all of a sudden this buying trend in houses, which was rising faster than you could shake a stick at. So houses kept getting up and up and up and up. And the crazy people were saying, it'll never go down. Houses will always go up. Well, all of a sudden, housing went down. So that left a whole lot of people with these huge, short-term, big interest loans that we used to buy houses, and all of a sudden they can't afford to pay their mortgage. That all happened in between 2005 and 2008, and all of a sudden we just drove everybody into the ground, including the whole damn world. Now, at this time, I think Europe is going to be the leader in all of this more than we are, because our economy is still doing a bit more better. The consumers are really the key to all of that. So at this particular point, we're starting to look an awful lot like 2007, 2006, 2008, that we're heading into a time where all of a sudden maybe all of this crazy stuff they've been doing is going down. Now, some of the keys to that that didn't happen before is our debt is huge. Credit card debt is up. And the worst part is the federal government's debt is up. We're $22.5 trillion going crazy. We're still spending money hand over fist that we cannot afford to pay back, because remember, the taxpayers actually pay all of that. We pay it with interest rates and taxes and so on and so forth. And this morning there was talk about, the president was talking about, well, we're going to give the investors a tax break, and that'll help things out. And then we're going to lower the payroll payroll withholding for all of the regular guys. Well, the curious part is that we're reducing the tax for the investors, helps Wall Street, so Wall Street is up. And again, the president, a lot of folks around him, Wall Street is everything. If Wall Street's wonderful, then everything is going to be good. And they don't talk much about the lower end of the pile. We already gave all the money away to the people who don't need it. We are now going to reduce the rates of the investors that really don't need it. And we're now going to reduce the amount of money that is removed from your paycheck, which is, his point is, well, wait a minute, that'll give them more money they can spend every week. No, it doesn't, because at the end of the year, when you pay taxes, you still have to pay the same amount of taxes. So you have to pay more at the end of the year because they took out less to help for that. Now, all of this is, again, we're leading into a point of where all of this craziness is going to come home to roost. The tariffs, which has screwed everybody to the ground, soybean prices are down, Christ, $100 since he did his stupid, deal with China. So, I mean, there's a lot of stuff that's rummaging around in there that is really not healthy for a lot of folks. So, at any rate, be careful. Put a little money underneath the mattress, save some cash, and you'll be okay. All right. Have a good day. Bye.